I think one of the things that's often said about panels when you're being invited to be on a panel is that you don't want to be on the panel right before lunch because you're keeping people from lunch, and you don't want to be on the panel right after lunch because people are kind of sleepy. So I get the joy of... Anyway, it's a pleasure to be here. I'm on this panel, a very important panel, talking about finding ways to support emerging developers of color. I think what I'd like to do to start is maybe just have each of the panelists introduce themselves and say what they are, what they do, just the sort of elevator speech to sort of get us started so the audience knows who's up here.
Sure. First of all, good afternoon, everyone. Mark James. I am the president of Urban Green, LLC. We are a DC-based affordable housing developer doing tax credit deals and home ownership projects. As you can tell by our name, we're very focused on sustainability, doing a lot of now net zero energy projects, zero carbon projects, and projects that are focused on human health.
Ms. Lisa?
So Julissa Carielo, I'm from San Antonio, Texas. I'm with DreamOn Group. I'm co-founder, co-partner. We do real estate development. We focus on community development projects that matter to the community that we work with. We focus in high poverty areas, and we do mixed use, commercial and affordable. But my first accidental development project was the Maestro Entrepreneurship Center, where I purchased an elementary school, started a foundation, and created the Maestro Center, which would focus on helping entrepreneurship and incubation and acceleration training for small businesses in San Antonio, in the poorest zip code of San Antonio. I am a serial entrepreneur. My first business, which is 16 years of commercial construction, but I've been in the industry 25 years, love construction. The reason I chose to be part of DreamOn Group was because I wanted to be part of the solution. I wanted to create things that could use my skills and talents to bring affordable housing and to help bring economic development to areas that need it the most.
Good afternoon, everyone. My name is LaToya Kyle, and I am the Vice President for Low Income Investment Fund, our Southeast region. LIF, as we are affectionately known by, is the national CDFI, and we focus on affordable housing as well as community facilities across the country. I lead our Southeast region based in Atlanta, Georgia, and was one of the co-originators of our Black Developer Capital Initiative, which supports Black developers throughout the country in providing affordable, long-term pre-development capital.
I'm Lydia Smith. I work for National Equity Fund. I'm leading the Emerging Minority Developer Fund, which is a fund that is designed to bring equity for developers of color into high-tech affordable housing development. National Equity Fund is one of the nation's largest syndicators of low-income housing tax credit. This year we celebrated our 35th year in business. So we have a vast amount of experience and contacts with investors and developers alike to bring these deals together.
Great, thanks. I think people here pretty much understand that there's a lot of barriers to entry for any developer really, but for developers of color in particular. Particularly, I mean, that would be true actually in regular development, but in affordable housing development, it's even harder. And I guess my question first to LaToya and Lydia is what barriers what challenges were your programs trying to address? What were you trying to overcome?
Sure, so I give some feedback into how we came about the creation of what we call BDCI. So prior to what we saw and experienced in 2020, our organization was having a lot of conversations around racial equity and social justice and our role in providing capital to the industry. And as we all know, we experienced the outcomes of George Floyd and the visibility around providing access not only to our industry, but to business owners around the country. And so we started to evaluate what role do we have as a capital provider in delivering this capital to underserved populations. So we began to have internal conversations with our staff as well as with our developers and realized that early stage capital is the hardest to source for anyone, but especially for Black developers, because they don't have generational wealth that ties into creating these funds, and they don't necessarily have the resources. So we also at that time had in our mission statement the alleviation of poverty, and the opposite of poverty is wealth. So how do we grow businesses and then also provide wealth creation for Black developers? And that's how we became to create our program, the Black Developer Capital Initiative. And so I guess to answer your question more specifically, what we're trying to solve for: wealth creation, access to capital, and the barriers that these developers were experiencing, whether it was in policy or programming that has been around in financial institutions for decades. So those were our initial efforts.
What barriers, like net worth requirements or balance, financial statements, or what other, were there specific barriers you're trying to address?
I would say D, all of the above.
Okay.
So, any and all of those things. And I came out of banking prior to working in the CDFI industry. And, policies and procedures are created in the financial institutions, and we as CDFIs also have to align with those because those are our funders. And what we decided to do is look at what our current policies were, and that was net worth and liquidity and leverage, and say, okay, are we participating in a system that continues to deprive certain populations of access to this capital? And so we shifted our focus from what historically has been done and created an experience-based product. Yes, we will evaluate them based on, not evaluate them, but we will review their financial status to see if we are helping to grow their business and to grow their personal wealth. But when we looked at risk in this section, what we realized is if you have if you're experienced, most of the time you can get these projects moving forward. You've done it, whether it's been at your other organization, with your own organization, or as a consultant. It's the benefit of time, and it's the benefit of working with a partner that values your experience in doing this and not your balance sheet.
Thanks.
Sure. So National Equity Fund's Emerging Minority Developer Fund is, as I said before, intended to bring equity for developers of color into the space. And so we are looking for developers who have some level of transferable real estate development skills that would give us and our investors some comfort about their ability to execute transactions like this. Some of the barriers that our fund is trying to solve is being able to help developers realize financial growth through greater retention of their developer fees. But then we're also solving for the barriers that we're also solving for the liquidity and net worth, that is a challenge for developers of color who don't have access to capital that way. And so our fund is able to provide guarantee backstops for those developers who are undercapitalized and not meeting the liquidity and net worth requirements that we traditionally require in our underwriting standards. And so wherever the developer's financials are falling short of those traditional requirements, our fund will put up a guarantee backstop to help our investors get comfortable with the level of liquidity, and we're also willing to extend that to the construction lender if needed. And so those are the main barriers that our fund is trying to solve for. But to LaToya's point, as continuing to do this work, we also realize that there are other barriers, on the front end. Our fund comes in to help when there's a LIHTC award that is available to be syndicated. And so how do you get to an award? A lot of developers face barriers in terms of the financing that's needed to do a lot of the pre-credit, pre-development activities that are required in order for them to put forth a competitive and viable tax credit application. And so as we continue to do this work, we're in the process of creating a program to be able to provide more early stage, as LaToya mentioned, capital that could be used for a variety of pre-credit, pre-development needs.
Great, thanks. Mark, maybe stay on barriers for a second before we get to solutions, but as you've tried to grow your business, to take on new projects, what have you seen as the major barriers to your growth as a business on projects and as a business as a whole?
Well, it's interesting because my story is not unlike many minority developers, persons of color who get into the development arena. I'm the son of 2 DC public school teachers. I told my mother I wanted to develop real estate, and she was like, "Boy, they ain't gonna let you do that." When I started off, she was kind of right, because in 2011, when I started the company, I didn't intend to be a development consultant. I had already done $225 million of tax credit deals, bond deals, and other financing for affordable housing for the 10, 12 years prior to that. But when I started the company, I'm still a rookie. And so the idea of coming in and saying to a bank that, hey, I don't have a balance sheet because we're starting, but I've got 15 years and $220 million of tax credit deals and developers all over the city who we've helped them to do their projects, and they're looking pretty, and I'm sitting here scratching my head going, how do I get there? That's tough. And so when we started the company, we recognized, I wasn't new to development. I knew what I was up against. That same DC public school teacher said, well, baby, we're gonna help you to get started. She's like, here's a check for $500. And then she said, now I want it back in 6 months. And I was,
Oh my God. Big money.
I'm trying to explain to her, like, these deals take like a year or two to do, Mom. And but it kind of says, there was no generational wealth to tap into. There was no rich uncle or parents. I hadn't saved up all kinds of money. If you all live in DC or any of the major cities, you're, hand to mouth every month trying to make ends meet. And I had 4 kids. My wife and I had 4 kids at the time. And so as we look at getting something like that started, those barriers are just what was mentioned. Balance sheet, a lot of experience, but not enough balance sheet, not enough liquidity to go in and say we can do the guarantees on deals. And all of a sudden, all the experience I had didn't really seem to count for much because we didn't have a big balance sheet behind us. Yeah. And so that's why the programs that were being talked about, were so valuable, and we've been able to participate in those.
So which program specifically do you participate in?
So we're with NAF, all the above, but NAF is doing the Emerging Minority Developer Fund, and they're doing a 9% deal for us here in DC. And we've got about 4 or 5 projects now in the DC area, DC, Maryland, Virginia. And we came to the table saying, hey, look, we really have to do something different with affordable housing. Because I've been doing affordable housing for over 20 years, but it keeps getting more expensive. The rents keep going up. It's not getting more healthy. It's not getting more sustainable. And all of these barriers that we're talking about really weren't being overcome in a significant manner. And then for me as a developer of color, I also recognize that, this, I don't want to understate this, you do need people that believe in you. Mm-hmm. That's important, and that's for any human being. You just need people that believe in you, and that will say, we acknowledge what you have been doing, and we acknowledge your experience, and we want to partner with you to overcome the balance sheet issues, because we do recognize that you can do a heavy lift with just a little bit of a push.
That's great. Thanks. Julissa, what's been your experience in terms of challenges, barriers?
I think that I agree with what Mark is saying, right? When you're an entrepreneur and you're a small business owner, there's no advantages to being a small business owner. There's no advantages to being a woman or a minority in business. You're going to pay more for everything. You're considered high risk for everything. If you're going on the traditional route of lending and all that access to capital does not exist in the way that it would normally when you put together programs that matter, right? And so I agree. I think that there has to be a choice that comes from the people that hold the money in the bag, that say we need to make sure that these people are included, that there is some diversity in the growth that's happening in the communities, and that we can get used to people that look like us that are doing the work that needs to happen, right? And that's something that is a choice. I think for me, I have been working for developers, building their buildings. I was constructing all kinds of stuff all over the state of Texas. That was my background. I worked federal, state, municipalities, and private developers. When I started to get into the development side, I wanted to do it because I felt that too much development was happening in areas that, live, work, play was happening in the north side, but not the east side, not the west side, and the areas that I thought we could really use economic development in these areas. To me, because I had been working so much on the small business entrepreneur growth side of what we do with workforce development, I just kept seeing the connection of affordable housing as that triangle that works together to create that economic growth. And I just felt like if we can bring it together and create that opportunity in those areas, we can really create the impact. And I was already working with our public officials and our mayor and everybody, and so they knew me as somebody who was going to go get things done. And so when I said, I want to work on this and I need support, they were there to help. But I will tell you, I am a very simple person. I look for people that are huggable. Those are the people I like to work with. And so the partners that we bring on the table are really people that become our family. So when I was introduced to any community reinvestment funds, Wood Forest was our first who actually stepped up and said, we want to be a part of this, and introduced me to a whole new world that I didn't even know existed. Eventually they were like, you need to learn about RASA Development Fund. They're very specific about the work that you're doing. RASA has been a part of our partnership as well, which has really opened the doors for us to do 3 times more than what we would be doing if we were doing more traditional with just my capital and just my equity. So it's been amazing to be a part of that. Now I'm in a fellowship program through RASA and Wells Fargo that is really focusing on developing developers that want to be in affordable housing arena. And so now I'm being taught so many different resources that are available that I would have never even had the opportunity to learn if I would have just been in my little town, right? And so the opportunities that are out there are tremendous, but it's only because you guys holding the bag are going to make the decision that you want to make sure that it happens. And we need you to continue to do that, continue supporting the CDFI programs because they're making a difference.
Thanks. I guess one of the questions in my mind about this, as I think about it, is whether what the effort is aimed at doing is bringing new emerging developers of color into the field, helping them, become sustainable developers, as opposed to a broader strategies that are focused on all developers of color, whether they're emerging or not. I guess I'd like all of the panelists' reactions to that about how you, to the extent you've got limited capital, to the extent you're, I guess part of the question is, what are we trying to do here? What are we trying to accomplish? What does success look like? Because you could look at it in different ways. It could be more developers of color involved in the business, or the developers of color that are in the business being more successful. You understand what I'm saying? Mm-hmm. And I think that is a policy choice for those who have the capital to think about where, how they try to focus their capital.
So I think that our focus is on all developers of color. Emerging, the fund has a name, the beginning of the fund's name is Emerging, but we focus on all developers of color. We're really taking a case-by-case approach to looking at who the developer is, what their experience is, what their financials are, what the development is that they're bringing to the table. We aren't able to take new developers who have absolutely no real estate experience because we're not developers and we don't have the capacity to take people from 0 to 100. And so what we're looking for is developers who have some level of transferable real estate development experience, being, the ideal situation is that they have at least completed one LIHTC development as the developer or co-developer, or you've worked for a larger development company for a number of years and amassed a vast amount of experience that, again, would give us and our investors comfort and your ability to be able to execute these sorts of deals. In terms of, you know, the more experienced developers, I'd say if we had a well-established developer in terms of their experience, but they lack financial capacity to do the pre-development, to take care of the pre-development expenses and to stand behind their own guarantees, that is the ideal type of developer that this fund is looking to help. On the other hand, if we have a developer who's well established, both in experience and has really good financials, conceivably, you know, you would think that that developer doesn't need a fund like ours and they could access capital through traditional means. So again, I say it's a case by case. It's really looking at each developer on a case by case basis and assessing what their needs are, working with them to assess that, and then figuring out how or if we can help. So yeah, we're looking at all developers of color.
I would say with our fund, so let me go back and kind of describe what our fund is. It is a long-term revolving unsecured line of credit to Black developers for pre-development expenses. So it's up to 5 years, and they can use it for multiple projects, and it's very favorably priced, and it revolves. And the objective around it is to allow them to support multiple projects, because what we know with development is you don't get paid until the project is complete. And with this rising interest rate environment, there's a lot of factors that could restrict how much they actually fund at completion. And so that slows down the process of them growing their business. If you're waiting for those funds to come in, how do you get to the next project and the next one? So with this one being long-term, multi-use and revolving, you can do more than one project at a time. So when we deployed the fund about a year ago, it's been highly successful. But in the launch of it, the criteria was you had to be Black, it was for profits only, and there was a liquidity, maximum liquidity restriction, and you had to do affordable housing. And affordable housing was open. We did not have a lot of definition around that. And we knew that we had to have proof of concept. So we probably started with some more experienced, more established developers to prove to ourselves, as well as to our capital partners, that this was a legitimate method of deploying capital using experience versus traditional underwriting criteria. As we've moved along the spectrum in deploying to more developers now, the profile of the developer has shifted. I wouldn't say it's a beginner emerging. They may be a new business, but that owner probably has worked 20 years in the industry, similar to what Mark described. So from that, we're now reviewing 2.0 of this same initiative, hopefully to launch next year. But what we did with all of the developers that went through 1.0 is we created a tier system, and we looked at their experience prior to the program, how many units they had produced, were they able to joint venture or could they do independent, and we put them in a tier. For 2.0, we are now trying to target, I guess, the lower spectrum of that tier. I wouldn't say emerging, because they're not emerging, they're established and they're experienced, but they don't have 2,000 units already produced, or they may have to joint venture. But what that is showing us is, in addition to this debt capital for pre-development, what other things do they need? They may need some grant funding to get some advisory services. They may need some joint venture partners that we could help support them with. So it's opening up a whole new spectrum of questions of how to support this next level of developer. And so to your question, who are we targeting? We would love to target everyone, but we have limited resources. But what we do have is a network of all of you all to align and figure out how to support more of these developers.
For Mark and Julissa, for yourselves and for, you have peers that you know in your community that are also trying to make a go of it. What do you see as the sweet spot in terms of who can be helped? Who are the ones who really need help and can use it? Is it the emerging developer that's got a little bit of experience? Maybe they were a contractor building single family homes, whatever. Is it that, or is it more the developer that's done maybe a LIHTC deal or two, but it's hard to sustain the business? I mean, that's another question broadly for developers is you really kind of need lines of credit. You need money all the time. And so the question is, what is the sweet spot, and what are the financing sources, capital sources that are really going to help?
Sure.
Yeah, I think one of the things that has helped us a lot is like what you're saying, the operational funding that was provided up front that allowed us to work on multiple projects at the same time to try to get them shovel ready. So all the pre-development costs that we have to pay for, it's a lot to do when you have multiple projects in different stages. What I also saw that was more of an advantage, right? Because I have been in the construction industry, the biggest risk in development is the construction cost. And the way it just kept changing, and it's so volatile right now. Even as much as I know, there's certain things that we still can't control, right? We know sometimes the supply, we can't get the supplies. I can get the roofing materials, but I can't get the roofing fasteners, which means I can't install the roof, right? Or I can get the light fixtures, but I can't get the electrical panels, which means the lights won't even turn on. So there's so many things that we're still struggling with. But I think there's also the labor shortage that is still in the construction crisis that we're in, right? There's not people getting into that industry, which means the costs are going to continue to rise. And so that is not something we can control, but we also know that it's coming. What I do like is that we're in the front of that market, and we're able to offer different options to try to get the project to fruition. Even though there's certain things we won't be able to do, there will be other options we'll come up with. I think that when it comes to the affordable housing component, we are struggling with the exact same things that you guys heard about earlier with the other gentlemen that were sitting up here talking about the $1 billion of the housing that they're doing. The affordable housing component, to get affordable housing done, you have to have creative lending. You have to have layers of different types of incentives or tax credits or something to help get the deal done. One of the things that we looked at was that because we believe so much in the legacy businesses in our community, we said, we're not going to go buy these people out. We're going to bring them into the deal and give them an opportunity they probably would have never had. And so we're bringing in their land and saying, stay in the deal, be a part of the owner, and get the same incentives that we're getting. But it allows us not to have to put out so much cash up front, and allows them an opportunity to grow and build wealth at the same time. And so there's different ways that we can look at it. There's different incentives when you're working closely with your government officials. They will be a part of it if they know it's going to create some kind of impact, and they all want to put their name behind it.
I think from my perspective, which I 100% agree, I think from my perspective, I'll add maybe 2 comments to that. First and foremost, I always like to start by just saying that developers of color are not high risk. There was sometimes a perception that developers of color bring high risk deals to the table. If anyone is a developer, the last thing they want is unnecessary risk. So if you're a developer who likes high risk, you're not a developer.
That's right.
You're a gambler. I'm not a gambler.
You got a problem.
And if we look at what's happening in the market today, we're talking 30, 40, 50% density increases in cities between now and 2050. And we're talking about cities where infrastructure is very old. We're talking about cities that are majority minority populations. We're talking about cities where the housing that may be there may already be 70 or 80 years old and higher. And so in order to fulfill the housing needs of the in-migration patterns into cities, and to also finance those properly, you're going to come across minority developers. Let's just get that straight, okay? And so when that happens, the question is there a perception of there being a higher risk here now? And thankfully, we're starting to get away from that. I'm happy to see that. But at the same point in time, there are also some things that we are, I used to be in banking before I got into development. And, the things that happen in loan review committees, sometimes we have to fight those, okay? There sometimes can be things, it's never the things that gets told to me that concerns me. It's what I didn't hear that concerns me. And so I think as we're looking at how we can do deals going forward and where the need is, liquidity is always going to be a need. When I got into this business, it was taking 1.5 to 2 years to get to a closing. Now we're at 3 and 4 years. And the way interest rates are, who knows? We might be at 5 years on some of these deals, just trying to get through NIMBY issues, zoning issues, and the like. But in the meantime, most of the minority developers I know can't hang on for 5 years to get a developer fee. They couldn't hang on for the 2 years. That was hard enough. And so the idea of having liquidity to get through a period of time is an issue. The idea of being able to help support the balance sheet with additional guarantee strengths. I would love to see more guarantee products out there that can help prop up a balance sheet or help to share guarantee risk, even if it's just for the short construction period term. There are things that can be done, but we all have to be willing to think out of the box. We all have to be willing to think in an innovative fashion. And so I like to say supporting developers of color is supporting innovation, because I think there's a lot of innovation that's yet to come out of our communities because it hasn't had a chance to really come out.
Speaking of innovation, one of the things, and this is maybe a digression, but not really, in Massachusetts, where I worked, 5 years would be a fast LIHTC project. It frequently takes longer than that because of securing the site. You've got to go through, assemble all the resources. You've got to go through several rounds to get an allocation. It's probably more, 7 to 10 years it could be to get a deal done.
In New York.
Do you have recommendations to fix that? In a sense, is there things that make the process take so long that stand in the way of being more opportunistic? It also means you're thinking about a deal in one real estate cycle. You're at another point in the real estate cycle when you're actually doing it. Right now, if we're heading into recession, this is a time to acquire. This is a time to be opportunistic. Yeah. So the question is there recommendations about changes in the system, which would really make it better for all developers, but because the affordable housing system is so complicated and so cumbersome and takes so long, do you all have recommendations on this? Buzz and I were talking about this earlier, because we're fighting a system which is overly complicated and takes an awful long time, and we're trying to provide capital to solve that problem, but maybe the problem is figuring out how to make the system work better. And as practitioners and as capital sources, I guess if you all have fixes to that, it'd be great to hear them.
Wow. I'll try to give a 2-minute response to that one, because we could be here all day on that one. I think the long period of pre-development, that we basically are doing, which the one that used to be 2 years, it is on one hand, we are trying to create policies that are improving affordability, and we commend that. And at the same point in time, the deal that I would have done 3 years ago today probably has $200,000 worth of more consultants that I need to add into it to make the deal work. My legal fees are $500,000 on a typical deal, and we are going in and trying to keep adding soft costs to these deals. Sorry, I'm preaching the gospel here. Here it comes. But these things are all of the red tape involved with affordable housing is part of what's extending this period. And NIMBYism is alive and well, and NIMBYism happens in Black and Latino communities too. You'd be shocked, but it's all of those things are adding up to extending the development timeline. And I think if there's anything we can do is try to figure out what we can do to streamline sort of that pre-development period. It takes me a year to raise the equity that I need, because I don't have, again, I can't tap into the $5 million line of credit, or I can't tap into equity stakeholders who are used to doing deals with us. So, for us as minority developers, what another developer might be able to do in 30 or 60 days, I might need 9 months to collect that same amount of capital and catch up. So never want handouts, never want someone to ask us to do a higher risk deal. Again, that's just gambling. What we're looking for, I think, is the opportunity to say, here's what a good deal looks like. We can show that we know, what the good deal looks like. But then in terms of shortening that period, we can also say, here are some innovative ideas that may be able to cut around some red tape. And that has to come from our lenders and policymakers who we need to come to do affordable housing.
Julissa, you have?
I have several different thoughts, right? And one of the things that, as an entrepreneur, I'm always looking at, like, how can we identify the process we're going to follow, right? And so when we started to get into development, I was like, how can we get the pre-development done in 90 days? Like, I was like, how do we get this done? Because it can't take that long. And so we know the steps, we know the consultants we need, we know the cost it's gonna take. It's really the checking and rechecking your numbers against the comps, and the cost keeps changing. And that's where we're just trying to get it down to, are we done yet? Are we done yet? Are we at the point where we're comfortable? And that goes back to managing that risk, right? And so we're still identifying gaps that are, unforeseen. We're looking for, what is going to be that contingency that we're comfortable with to get the deal done. I think to me that the projects that have been easier for us, if it's 50 units, we can get those done pretty quick. If it's related to historical buildings, historical tax credits, consultants and reviews, and what's going to be allowed, not allowed, those take a lot longer. The ones that we need community buy-in are going to take 6 months more time, because we need the community buy-in and we need that process to happen. There's certain things that depends on the specific of those projects that are going to be handled differently. And I think that it's just understanding that is the process we're going to go through, because that is how we're going to make sure that it's acceptable and it's going to really matter to that community. And so there's so many things that we do, but I will tell you some of the advantages is also teaming up with others that have done it bigger and better, and that are willing to come and say, you know what, let me help you, let me bring in some resources, and we offset that, and we're able to move a lot quicker. So those are other opportunities too.
Sure.
So do I have solutions? I have a lot of them in my head, but what I would say is, in the meantime, how do I support, as the CDFI, the developers in that 5-year process? So one of the examples that you just mentioned about partnering with a larger firm, I think what our program does through the BDCI product, it provides capital to a smaller developer so that when they go into these conversations of partnering with a larger company, they have more leverage in the negotiating power and negotiating power. Sure. So previously what we would see is a small, minority developer going in and having to give away, all of the developer fee because they're not bringing anything to the table, or the perception they're not bringing anything. But if we provide a pre-development loan to you and you're doing all the hard early stage financing, architectural drawings, you're now delivering a product, and all you need from them is maybe the guarantee support. So we're putting them in a better position in this 5-year process. And then also I would say actively having conversations with policymakers, because what we're seeing I'm from Georgia, it costs $300,000 to $500,000 to put an application in. Is that necessary? We've now completed how many thousands of affordable housing units using LIHTC? Why is it getting harder and not easier? Why is it getting longer versus shorter? So there are some things in there that in my head I would love to have some conversations around. Is that my role? My role is to support through capital, and I think that's what we're trying to do.
Sure.
I think everybody has encapsulated it well. I think it does take a village, right? And I think that there does need to be more collaboration from policymakers to the allocating agencies to lenders to the syndicators, like maybe sort of a task force to talk about, right, how to streamline the process and how to make it better to shorten it for the developers. Similar to LaToya, our fund is supporting the developers, but we're also giving them some additional leverage in terms of the guarantee backstop. So if they know that we're interested in their development, then that gives them a little bit of leverage if they have to, for whatever reasons, take a partner. So.
Great. I guess I'd like to turn the conversation now to sort of how's it going. for those of you who put programs together, or those of you who are trying to take advantage of it. What worked, what didn't work, what are the lessons learned, how should the programs evolve over time? Why don't we start with the capital sources first in terms of the deals you've done and how they've gone, how's it worked out, what were the surprises, what was easier than you thought, what was harder? Things are never easier, I guess, but maybe.
Yeah, so to date, we have identified 7 developers of color that are participating in our program. The first closing is scheduled or expected by the end of this year. We have provided support or proposed support, being that some of them haven't closed, but we will provide support in terms of the guarantee backstops for 5 of 7 of those developers who are undercapitalized. We also are providing additional technical support for those developers in the form of consulting dollars for what, sometimes they may need an owner's rep or some compliance consulting. Sometimes it may be some business consulting to help them set up business structures and business practices, maybe some compliance-related legal and accounting advice. And so these are the types of supports that we are able to provide with this fund. So the 7 developers that we've identified are accounting for more than 50% of our $132 million fund. One of the things that has been a challenge for us has been the length of time that it takes to get the deal from secure to closing. And in a lot of cases, we find that it is because some of our developers don't have capacity to, keep up with all of the diligence items or get them. Some of those things I understand are not in the developer's control, but some of it relates to capacity. I think for some of our developers, they are not, unfortunately, they're not in a situation where they're able to quit their day jobs to build a business. And so, we're contending with just competing to get, their attention. I won't say that they're not paying attention, but I will say that our developers are very busy people. So what we've done to sort of mitigate that is look on a case-by-case basis and see what can we do to help keep moving the underwriting process forward and help advance the deals to closing. We are continuing, so we're about, as I said, more than halfway committed on the funds that we have, and we're continuously looking for and recruiting for developers who fit the profile as a developer of color that we're trying to serve with this fund.
You talk about having approved 7 developers. Mm-hmm. Is it developers or deals? In other words, are you?
It's developers with deals.
Developers with deals.
Mm-hmm. So for our fund, we're looking to help the developer of color, but there has to be a deal there. So our fund is a multi-investor national fund. It's a LIHTC equity fund, which means the LIHTC award is required in order to participate in the fund or any of its additional benefits.
Do you see these as ongoing relationships, though? Do you see these as?
Absolutely.
Yeah.
Absolutely. That is our goal. We started this fund, and we have said from the beginning that we are not really looking for the one and done. We're looking to partner with developers longer term because we do know that there is an affordable housing crisis. And so we want developers who are committed to continue to try to, address that. So.
Sure.
So LIFT's fund was also in collaboration with our joint venture partner, National Affordable Housing Trust. So at the time we made our announcement, our partner also made an announcement that they would commit a minimum of $50 million for LIHTC equity, and LIFT's 1.0 of our BDCI was $20 million. So the fund that I speak on is the debt portion of it, the $20 million. We launched it less than a year ago. Since then, we have closed $17.5 million of it, with the balance already committed to developers. They're in underwriting. We've already seen 2 of the developers deploy up to their maximum amount, repay, and redeploy a portion of that. So we have supported 21 projects up to 2,000 units. So we've already seen some immediate success, and as I mentioned, we are raising capital for 2.0, hopefully another $20 million. One of the challenges, because it is an experience-based product, is how do you convey your experience unless you are a developer that has multiple units, a full staff, but if you're a two-person shop, how do I tell you what my experience is? Or if I may have previously been an employee or a consultant, what do you need for me to show you I'm experienced? So we originally started with an Excel format and said, okay, put here what all the projects you've worked on in 20 years. What was your role? Were you the finance person? Did you do construction? What did you do? So from that, we've now created a template that we give to all our prospective borrowers to prepare a presentation of what have you done throughout your career, so we can translate that and be consistent in our presentation. So that was an original challenge. I would say a bigger challenge was the internal conversation about creating this fund. It was not easy. It was a hard conversation. As I've mentioned, our fund is called Black Developer Capital Initiative. It's very intentional that it starts with the word Black. Versus, right now there's a lot of conversation about, I think the panel is developers of color. So how do you convince an organization that you want to focus on a specific population? And we're for-profits and not nonprofits. How do you have that conversation? So it for myself, I know it spurs a lot of anxiety, and because it's personal for me, just in case you didn't realize, I am Black. And so it's like, how do you have this conversation with people and decision makers that are not Black? And then we use capital providers, and those rooms are different. So one of the outcomes of that, once we deployed it, we kind of celebrated for a moment, but then we had to step back and say, well, this was hard, and why was it hard? And how do we make the next decision we make around any of these race-based initiatives not as challenging? So what we have also uncovered is a decision-making metric within our organization about who should be in the room, who's not in the room. And when we go to the next level, who should be in the room there, who's not reflected in the room? Is it developers' voices? Is it employee voices? And how do we make decisions? So it's hard work. It's very gratifying. I have had borrowers cry. I cry with them. I've had potential developers call. That's another challenge. We only have a little bit of money and a lot of need. Mm-hmm. So we get called. I have a database right now. So anybody who wants to do this, if you're worried that we can't deploy it, we can. Call me. We can get this out for you, or you can get it out yourselves. But there's a big need out there. And so I had someone call and she said, are you real? I've seen all these announcements. Are you a person? Do you really have money? Yes, we have money. We've gotten it out. We're getting it back. We're trying to do more of it. So if I have to say the final challenge with this is getting more capital out to the market.
One quick question on we're a pre-development lender as well. Pre-development lending is high risk, just by the very nature of it. It has nothing to do with the color of the developer or anything else. It's just you're putting money in before a deal is fully formed. How has that, have there been bumps in the road? Have there been deals that have fallen out? At what point did they fall out? The sort of tough, the question you're going to get from your lenders, right. I guess. I'm asking the question that all the lenders in the room want to know the answer to.
Absolutely. So no, we have not had any fallout, but I think it's a testament to just making good decisions on the front end. But I will say, so our program is propped up with a 10% top loss from a funder. And before we requested, so it's a $20 million fund, we have $2 million of top loss from a fund. But we had to decide, how did we get to the 10%? When we first started the conversation about risk assessment and how much top loss do we need, we were at 50% because there's this idea that, and I don't know, was I a participant in this idea that we were now lending to a more risky population, or were we lending to a more risky product? We're 35 plus years old. We have nominal losses doing this same type of work. We've been doing pre-development lending all the time with very little losses. So why was it when we now shifted our focus to Black developers, were we thinking about having a higher risk assessment? And so we started to look at where does the risk lie in mostly LIHTC deals. It's in that very early stage, pre-award phase. We were not, but most developers aren't even going to ask for that much money. So at that point. And so we kept backing it down. So, okay, if this is the risk, we maybe limit how much we give you before you get your award. Once you get your award, where does the risk lie? Once you get your construction commitment, where does the risk lie? So we were able to bring it back down to 10%. As far as the top loss, we have not needed to call on that. I don't expect that we need to call on that. But it's also being patient in the process, because we know that time heals most deals. And so if you can be patient and work with experienced developers that, you said you're huggable, I will give you one after this. People that, I like you, I know you, and, I'm going to go and be an advocate for you, but you have to prove to me that you're worthy of, of my trust in you, so.
Of course.
What's the top loss in Fund 2.0?
We probably will be at that 10% as well, because I don't know if the capital providers are ready to support it without.
Yeah.
I think we have now proven with some of our clients in it so far that they should be able to roll off of the program and maybe expand that loss to some new developers. We're having those internal conversations about how do we take the top loss that we already have to create more availability for more borrowers.
Well, for Mark and Julissa, what has your experience been utilizing some of these programs? What's worked, what hasn't? What's been most helpful? What's created new challenges?
I think that the learning about all the opportunities that are available has been really interesting. How to implement them in our projects has been numerous conversations with our, with Raza to help us line up how do we approach it better, what are some other things, because we're getting access to other equity and other capital, and we're looking at every opportunity that's out there. Can we layer it? Can we bring it together? There's PACE, there's other programs. Should we be considering it? And when we're trying to keep it affordable, we're looking at everything. When we're looking at sustainability, we're looking at everything to see what's going to really keep it affordable for the people who actually move in, not just us trying to do the deal, right? And so there's been a lot of opportunities of learning of the new things that are out there, and even being creative of how we approach our local government to participate. That's been something that I think has been a big benefit, because once we convince them to be part of the deal, or we do a public-private partnership with, the tax exempt stuff, it really changes the whole dynamics of that transaction, and it really makes it a lot easier for us to get it done and feel comfortable knowing that this is going to be affordable for the end user. And so there's been a lot of those advantages. I think also the fact that we're doing the mixed use, we're looking for components where we're able to do either new market tax credits on part of it, and then we're also asking for, is there extra time for stabilization, because it is in an area of town that is not considered the active, that's going to be pre-leased 100% prior. We need activation time, and we're able to get flexibility with that. What I have really enjoyed in the relationship is that we're able to give updates periodically of where we're at on each of the projects and where we need assistance, and we get that support right away, and that to me has been a huge help.
So you've been building relationships as well
Yes.
as building housing.
Right.
Yeah, I'd probably say we're similar. We've the program that we're doing, both with NAF and with LIF more recently, is what it does is I like to say to the people I work with that pipeline creates pipeline, and so suddenly that as we are we have 3 closings, over the next 14 months. And as we're looking at that and looking at what's been accomplished, all of a sudden now we have, 100 and, I think last time I looked, close to 200 million of pipeline in front of us. So as you're looking at these projects, you're realizing that what these programs are doing is building a new platform. So we're not launching from the old platform. We're launching from a more stabilized platform, And it's still about doing good deals, but now we have, as a developer, I can more confidently begin to predict, what the next 2 or 3 years look like. And that means a lot to any developer. The idea of having some certainty about what the next 2 to 5 years may look like in your development pipeline. So the fact that we've been able to go in and had our balance sheets, begin to get bolstered a bit, but also have confidence behind it. The fact that these programs have been able to come in and bring capital in that either we would have never gotten or would have taken us a long, long time to get has allowed that platform to be created. And then I think the other part of that is that because we do a lot in the area of sustainability, we're committed to 100% net zero energy production now. We're committed to trying to hit at least 75% carbon neutral communities as a part of our portfolio. A lot of the communities we develop in, no one cares about the health of the people who live there. So we're really committed to human health within housing. So the fact that we've been able to start resolving these other financial issues means we can focus on the innovation. And that's really where you begin to impact people. So this idea of partnering with banks who we know that are doing investments, NEF and LIF are my first phone calls now when a new deal comes up. They are the very first people we're calling because I know they've made a commitment and they've shown a vote of support for what we've been doing.
That's great.
I would just add one of the things that as entrepreneurs, we are super resourceful. We are going to be doing things in-house a lot more than we're going to go spend money to do stuff because we're used to doing a lot with little, right? And that's something that goes a long way. And I think that also it's important to understand that we are doing things like, for us, the DreamOn group, we focus on projects that are going to matter, and we're picking and choosing which jobs we're going to do and which ones we're not. We ask ourselves, is this a DreamOn project or not? Does it create impact? Does it create community change? And does it bring opportunity? If it doesn't hit the criteria, then we don't go do it, right? And so for us to bring a deal to the table, it's because we're already convinced that we have the partners in line to get the job done. And when we're selling it to our teaming relationships and our banks and our CDFIs and stuff, they already know we're hitting those targets, and it's going to make it easy for them to sell that deal too.
Great. Why don't we open it up to questions from the audience? It's very bright up here.
We scared everyone.
No, there's somebody over here. Yeah,
I see one over there.
over here too.
Hi, Glenn Hudson. I got a question for each of you as it relates to growing minority developers, and I work with minority developers and CIP and for-profit developers across the country as well. But I haven't heard any of you talk about getting state HFAs involved in the QAP process of giving points in the QAP process for minority developers in Virginia. We started doing that in Virginia, and was just wondering whether or not it's happening in your respective areas as well.
I can say that it is happening, and outside of Virginia, I know of a number of states who have initiatives and written initiatives into their QAPs for BIPOC developers. Some give additional points. Some are, for equitable partnerships requiring a certain level of ownership and developer fee for the BIPOC developer. So that conversation is happening. Action is taking place. It's not, pervasive across the nation, but I think at different forums, maybe NCSHA and some other of those national platforms, those discussions are being had, and I expect to see that more states will sign on and subscribe to putting more equity into their QAPs going forward and making them more robust. Again, not beyond just giving additional points for BIPOC developers or partnering with a BIPOC developer. What we'd like to see, like with our EMDF fund, developers are, the best way for them to grow their businesses financially is to be able to retain their developer fee. And so ideally, our fund would like to have developers participate without the need for a partner, but we do understand that sometimes they do need to take a partner. And so because it is a BIPOC focus, we need to see the BIPOC developer have at least an equal share of the developer fee, if not a majority share of the developer fee and ownership. And so some of the states I know are adding language like that to their QAPs.
In Massachusetts, they have done this, but they really look at the whole team, because it is important that the whole team be representative of, businesses owned by people of color. There's a lot of money that goes to lawyers and architects and other people, general contractors, so it's important that in all of those cases, the team include, businesses owned by people of color. And that, one thing I would say also is again, this is in MHIC's, 32-year history. We got started around a racial equity issue, but these discussions we had 5-10 years ago with public officials and banks were very hard discussions. That's really changed. The state was very open to this. The banks were interested in what we're doing. Developers who we worked with where we established these racial equity goals, those were hard discussions 10 years ago. Those are not hard discussions now. People understand the importance of this. So I think there has been a shift, and the question is how to take advantage of that, how to use this opportunity to really move things forward. There was another question?
Hello, Frank Woodruff with NAAHL. My organization issued a research report about 2 months ago on the community-based development community, so nonprofit community developers. Identified about 5,700 organizations the Urban Institute did on our behalf, with $54 billion in assets and $28 billion in annual revenue. But one of the more concerning trends that the Urban Institute identified was that about 85% of the assets and revenue within the field are controlled by about 25% of the organizations. And so, we'll have data in next year on this, but our suspicion is that a good number of the smaller developers are minority-led. And so my question is for Ms. Kyle, a little bit of your decision about for-profit and choosing not to include nonprofit developers in your fund is kind of my first question. And then for the panel, maybe more broadly, a related question is, when considering or encouraging smaller developers, especially nonprofit, to partner with larger organizations, that can sometimes be touchy. You sometimes run into issues of tokenism, having the smaller organization do the community engagement and all the stuff that doesn't touch the money, basically. And so kind of two separate questions there about how you would navigate, how you navigate as at institutions, or how you've navigated that as developers. So 2 questions, I guess.
So about how did we come to the decision to focus on for-profit versus nonprofit? LIFT, throughout our history, has created a multitude of projects and programs that are open to nonprofit organizations. And for example, we have a partnership with Purpose-Built Communities, which is a community-based or affiliation of community-based organizations that do a variety of work around education, healthcare, affordable housing development. We had the Spark Initiative, which supported nonprofit community engagement. So we've had a multitude of products that supported nonprofits. With this particular program, because like I said, we started with the concept of wealth creation, and when you have a nonprofit, there's not the ability for an individual to create wealth for themselves as well as for their legacy and generations to come. And so we wanted to start with that in mind, wealth creation, and we also wanted to start with what is hardest. I think capital flows to nonprofits easier than it does for-profits in this space. And I've worked with organizations where I only lend to nonprofits, and I've also seen the impact of trying to support for-profit organizations. And so we felt like if we could start with the hardest and show that it works, then you can move to the easiest faster, versus if I start with the easiest, then we stay there. And also remembering this came out of some of the recognition of the disparities in 2020. You know, all the conversations that the banks were having, capital providers were having around Black Lives Matter, and the access or lack thereof of capital to this population. That's why we made the decision to focus there. We are now having conversations with 2.0 of expanding it. And does that mean nonprofits are invited to this next round? Initially, it was an East Coast only opportunity. Now we're having conversations about expanding that to the West Coast. So as we move throughout the process, we are evaluating, does this tool open up opportunity for other populations? And I will also say, out of this, we created, or in conjunction with this, we created what we call the IRP tool. So it's impact, risk, and profitability. And it is a tool that we use to assess all of our loans, not just the BDCIs. And we look at the impact that it has in the neighborhoods, the risk profile, as well as, you know, the profit that we're making out of it. And what we want to do is, impact is, you know, we lead with racial equity and racial impact. And does the developer and or the project have an impact in that community or society as whole? And if so, then can we make some more concessions, whether you're a Black developer, for-profit or nonprofit, and make some decisions on lending practices that were based out of BDCI, but now applicable to all of our projects. So we are using BDCI as a learning tool to launch other initiatives.
No. I can try to answer about the partnership part of that, if you'd like. You know, from our standpoint, we love partnerships. You know, if you're a developer who doesn't like partnerships, you're not all that smart in my mind, because, you know, just like the lender, we also as developers want to share risk into a deal. And I'd much rather have partners, you know, but it's got to be the right partners. And so the idea of having partners who only want you there because of the color of your skin is something you only pick up with experience. You know, what that looks like before you're immersed in it, and you keep wondering why there are meetings and you're not being invited to the meeting, you know, or why there are financials being asked for, but no one's asking you for your financials. And you realize, oh, well, I'm just kind of, you know, here because they needed, you know, my pretty face. That's right, you can laugh. You know, they didn't, you realize that it's not really the thing that you really want to be a part of. So experience tells you what are the right partnerships to look for and what are the healthy partnerships to be a part of.
I would add that as business owners, we get to pick and choose as well. And so we get to make the deal and negotiate what we want to be a part of and how we want to be a part of it. And that is something that we could always say no to if it doesn't look like, you know, and I've been invited to stuff like that. Yeah, they want, you know, they want you part of the deal, but they don't want you part of the deal. And so those are the ones that we kind of have to say no to. But I think that there's a lot of opportunity when you're teaming up and you are sharing the risk and you're bringing in other resources and other talent that is going to just double check everything you're doing, which to me, it's just a win-win. And so it's a business decision as well.
I tell all developers that I talk to that it's very important for them to know the partner that they're approaching and trying to develop a partnership with. And that if they're, you know, I encourage them to look at a prospective developer's website to see if they have any sort of DEI statements, to figure out if they've made any sort of commitments to racial equity. Also, just kind of talk to them about, you know, if you're having conversations with a prospective developer and they are, you know, obviously laser focused on the bottom line, but not really subscribe to the mission, then that's probably not the right partner for you. For this fund, like I said a little bit ago, the partner matters. And so, you know, to help avoid that sort of tokenism, you know, we put in that minimum requirement. It is a BIPOC focused fund, so we do need to see the developer of color have at least an equal share or a majority share of the developer fee. And so that is a good way, but then we also encourage the developers to, as Mark and Julissa have said, don't allow yourself to be absent from any of the meetings that are happening. Even if people say it's okay for you not to be there, you should be at every meeting. You should be a sponge trying to, build as much on your capacity, development and experience and capacity as you possibly can, in addition to your financial growth, right? So that ultimately, at some point, you don't need to partner or you don't need one of these initiatives. You can stand on your own.
I guess we have time for one more question. Yeah.
Over here.
Can't see over there. Here we back of.
Hi, my name is Ronnie Slammin, and I'm the founder of Embolden Real Estate Development Company, and I am an emerging developer of color. And my question is, from my experience, it seems like there's a lot of resources out there from LIF, NEF, and I would say Capital Impact, which I'm a part of. And can you kind of talk about what's happening behind the scenes to kind of hodgepodge all these resources together, whether it be debt, equity, backstop guarantees, and from this side of the panel, and then from the developer side, how are you navigating that to try to bring them all together to keep as much ownership and participation as possible?
So for us, to start, before we even get too far into conversations with the developer, we definitely want to understand who the development team is, if they're taking a partner, and if they are, what have they been able to successfully negotiate. We have, I mentioned this, a multi-investor fund. We have 11 investors in this fund. Our investors are open. They share our mission, as far as advancing racial equity among developers of color. And so they are open and looking for opportunities to be able to provide both the construction and the permanent debt for developers that are participating in this fund. We ourselves are in the process of trying to create a program, as I said earlier, to provide some earlier financial assistance to help with those pre-application costs. Once a participating developer has a LIHTC award, and we have a signed LOI, that opens up access for them to our pre-existing pre-development lending program, which will help bridge them to closing for the equity and with their construction loans. We are an affiliate of LISC and the Local Initiative Support Corporation. LISC is also a partner, and sometimes developers, we make referrals to them, they make referrals to us for people that they're talking to. LISC is another pre-development lending source that is available for developers of color. So it's our work.
And I think I may interpret your question a little differently as far as like the partnership amongst all of the different funding products and announcements that have been made. And that's kind of one of my personal goals, and I think one that LIF has had conversations about as well, is how do we create an ecosystem that brings together all of these initiatives so that it's a one-stop shop for you as a developer to say, okay, I have all these needs, who do I go to? Because I focus personally in the Southeast, mostly multifamily, but if you're doing single family in a rural area, where do you go? So I think there's great opportunity for us to have more collaboration within the sectors about, what our different initiatives are and how do we then deliver that and announce that to, the population. It's a work in progress, but I would love to get your information afterwards and see how we can stay connected.
I'll just add in real quickly that I think from the developer standpoint, trust, once you've learned to build trust, it's important to go in and be transparent. Mm-hmm. A lot of people in this room will know what I mean when I say, that whatever, if the requirement was 80%, my mother would be like, well, honey, you gonna have to have 90%, and so one of the things that leads to is the idea of trying to inflate yourself, unnecessarily to look bigger than you are or look more experienced than you are, because there's this pressure to deliver and to be, accepted by those that you're asking to work with. But I would say now that it's better to be transparent and to, really highlight your strengths, but be willing to also share your weaknesses. because the programs like these are wanting to know what those are so they can help them. But if they don't know what those weaknesses are, it's harder for them to fix it. So that would be part of the advice I would give.
Lisa, anything to add?
Yeah, I would just say that it's, each deal is different. Each deal has a different type of components that we're going to be able to tap into. And a lot of the stuff that we're learning is different from state to state, right? And we're trying to identify which one can we apply, or is there anything similar in our state that we can use? I think that the transparency is something that for sure it's talking to, you know, like we talked to Raza first, then we talked to Wood Forest, and then we talked to Wells Fargo, and then we get, for us, it's thinking that, you know, if the deal is going to be $70 million, well, one can't do it alone. They're gonna come in and work together, and we're just looking for those teams that are willing to say, you know, here's what we can do, and together we're going to bring this together and make it happen. And so bringing those resources is really more of the communication we're doing with each of them and the updates we're doing every month of where we're at and where we're moving forward on each of the projects and where they want to participate.
Well, our time is up. I want to thank the panel. It's been a great discussion. It's great what you all are doing. And I'm sure there might be people in the audience who might be interested in partnering with you going forward. So with the audience, I'd like to thank you for a great panel.
Thank you.